Today, we're going to talk about pricing and deal structuring with a view to selling a business, although this can also be mapped on to buying a business, of course, if one of our clients is on the other side of that. Just a real quick on who we are. Transworld is the largest sell-side broker for small businesses in the world with 250 offices globally, and we have about 15 offices in the UK. We basically work with small businesses that want to sell, or very often businesses that want to buy other businesses. We don't charge upfront fees. It's a 40-year policy. And we like to think we take care of our clients and see this more as a vocation than a financial transaction. So we tend to have more experienced advisors. We don't have salespeople or junior people that end up trying to run accounts. I myself was a chartered accountant with Ernst & Young. I'm a certified business valuer. I've written 4 books, one for people selling, one for people buying, people that are looking at working with private equity, and also one for practice accountants. Okay, so let's talk about pricing and deal structuring versus valuation. So basically, when you do valuation, when I was in my valuation courses, you have to first understand why you're valuing a company. And the irony of this is that you can come up with different answers depending on the reason you're valuing, because the rules are different. Obviously, you can value if there's a divorce, if there's a death, and there's inheritance tax, sometimes for tax reasons and tax assessments. And of course, there's the use case of a business sale. And there is math around this. There is methodology, of course, but you can come up with different answers depending on the use case. How useful is this when we're actually selling a business? Marginally useful, because really a business is really only worth what someone's willing to pay for it. That's kind of an overused phrase and not totally accurate, because it makes it sound like we're selling a Mercedes, and if someone's willing to pay 15 grand, that's what it's worth. It's actually more complicated than that, but that is the gist of it. In most cases, the actual mathematical calculation part of it is you're selling a future cash flow for most businesses. You think of a cow, and what you're doing is selling the future milk of that cow. And that was important to understand the future element of this. I was a trained accountant, and I didn't realize how backward looking most of my training was, right? Historical financials and all that kind of stuff. When you do valuation, I had to turn my head 180 degrees around and actually look at the future. And so the models are all based on how much is a future cash flow and the whole thing around that. So basically, we do use historical financials, but they are sort of a tool to help us determine what a future cash flow is going to be. Now, these are very sort of generic explanations. I get that, but it kind of sets the tone for what we're really up to. One of the things when I was in my valuation courses, they said, and it kind of blew my mind, is that valuation is 60% science and 40% art. Now, being a trained accountant, you don't say art and accounting in the same sentence. That was a bit mind-blowing. But as I've had this job of actually selling businesses for the last 8 years, I've actually done over 100 transactions or whatever. I really get it. There is a mathematical basis, but if you kind of get it, that it's the starting point and not the ending point. And I think it's another place that people get confused. The math gets its going, if you will, but it's not the end of the story. Okay. And also deal structuring. People try to visualize that a business is going to sell for X and that's meaningful to them. The reality in practice is it's not like a car or a house where you have a number and that's that. Deals are more like a wedding cake, where, a wedding cake with lots of layers on it. And you start with a closing payment. Okay, how much you're going to get on day one. You might have deferred payments. Deferred payments and closing payments, when you add them up, tend to be the core enterprise value. I always say that deferred and debt start with a D, so you can remember that it's debt-like. You then end up with another component, which is earnout, where you might, another layer, the wedding cake might be a contingent amount to say, hey, we'll give you this amount for the business, but you're telling us this new contract is coming in that's going to be worth a huge amount of money. It's not reflected in the historical financials. So tell you what, we'll give you 75% of the profit of that in the first year because you're the one that brought it to the table, Mr. Seller. Things like that. So you get, and we tend to call these earnouts, and people get confused because they think the seller has to stick around and work and earn it out or whatever. It's a better word for it is contingent payments in addition to the guaranteed payments handling like a bridge between what the historicals are showing and what the future might bring. You also have the post-sale consultancy. How much is if the seller stays in the business, are they going to be paid after the fact? It can be quite a lot of money sometimes. Normally, the rule of thumb is people want to leave within 6 months of selling a business. Any more than that, and you get the entrepreneurs became an entrepreneur for freedom, and the last thing he wants to do is have a boss for 2 years. Is the last thing he does in his professional life, and you don't want to engineer a jail sentence, So usually people sell businesses because they want to leave, and so a good sale is when we found the right new owner for the business where the existing owner can leave. The owner might also roll equity in the business. He might say, this happens a lot with private equity. We like what you're doing. We want a second bite at the cherry in 5 years when you sell. And the owner might retain components of the business. He might have bought a Ferrari and he gets to keep the Ferrari that's worth 150 grand. So there's a lot of things that go into a deal structure. It's not just a number. And sometimes when we talk about valuation and pricing, we try to reduce it to that. And then there's another dimension I'm going to get into in a minute about who the buyer actually is and the risk factors. And so this is where we get into the art part of this when we're actually doing deals. Now, the other thing to realize is that in some ways, offers are a dime a dozen in our business. 75% of deals that reach heads of terms. So remember, we work in the small business sector. In small business, let's define it as under 10 million enterprise value. That means probably something like generally under 20 million turnover. Let's put it that way. We have clients that are up to 50 million turnover. Sure, we do, but the average is probably 10 or 20 million, and we're selling them between 1 and 5 million is our bread and butter. But anyway, in the small business sector, 75% of transactions that make it to heads of terms or LOI don't make it to the closing table. So 1 in 4. So it's pretty horrible statistics. 60 to 80% of businesses that go up for sale in the UK in the small business sector don't sell at all. Now, this is important because remember, the guy actually went to sell the business because he wanted to leave. Why does he want to leave? Because he's 65 and he wants to retire. He has a health issue. His wife is retired and they want to go on cruise ships. Who knows? But he wants to leave. So if 60 to 80% don't sell, well, suddenly that's going to influence what the deal structures look like because he might be much more pliable because the other alternative is potentially a liquidation if he doesn't have someone in the business that can take it over. So all these things factor in. 50% of transactions do not deliver on the stated objectives after the fact. This is an amazing statistic. We got this one from bigger M&A, and it literally people doing in the hundreds of millions. It's the same statistic. So M&A is not this great thing that, after the fact, everybody gets rich. It's a tough gig. Done correctly, it can be fantastic because you're dealing with people at a life change. Next to getting married and having kids, selling a business for most small business owners is the biggest thing they do. And it allows them to continue their journey away from their business. And if we find the right new owner, I always use the term new owner. I don't like the term buyer. It's the wrong energy. But if we find the right new owner, it's also life-changing for him, and it's also life-changing for the people in the business. So it allows them to continue on their journey. So you start to get the feel of this as there is a mathematical basis to business sales, but there's a massive people side to this as well, all going on, all mixed together when we're trying to get deals done. Now, who are these buyers? And again, what you might sell a business for and how you might sell it will depend on the buyer. Remember, the new owner has to be able to replace the leadership of the guy who's leaving in a small business. This idea you just buy a business and you don't know anything about it in the first tier management will somehow magically run it is not a thing in small business. I've been doing this for 8 years. I'll tell you that. You need to be able as a new owner to somehow replace the leadership, not management, but you need the people that are those managers need to respect you. They need to look up to you and not leave the business after the fact. You need to, the old owner, he was a leader. He ducked and dived. It's what he did during COVID. He hired key people. He got into new, he pivoted and got into new product areas and things like that when it was appropriate. That leadership element gap has to be replaced, and it's replaced in different ways by different types of buyers. Obviously, a trade buyer that's buying a similar company, that's easy. They're already in the business, so that's a no-brainer. Private equity has their way of doing it. They're very good at putting 5-year plans together and surrounding key managers with a CFO and a gray-haired chairman and things like that. An individual operator might be from that sector, and he's just moved from Manchester to London, and he's looking for a business to run, but he's run that type of business before. So it just depends, and depending on who these are is the kind kind of deal you're going to write. If it's private equity, they have a lot of money. They tend to have funds or they can get their hands on money. And so the risk with them is actually lower when you do a deal. It's much harder to get a deal done because of the FCA regulation and all that. But they've got a pot of money. They typically don't have to borrow lots of money, or if they do, it's very easy for them to do. An individual operator who may be an absolute perfect fit to take over the business, so Bob can go on cruise ships with his wife, may not have a ton of money, and we may only have a couple $100,000 to put into a £2 million transaction, and we need to work with him on how to do that. And so we have the right new owner, and so we have to work with him where he is, and we will also help him. We have debt consultants and things like that, and doing business modeling. All this is necessary. So you get different types of buyers. Management buyouts and employee ownership trusts are not as common as you think. And the reason is that most of our owners are X factor leaders. They're this leadership we were talking about, the ducking, the diving, the vision, the sleepless nights. And typically X factor leaders don't work for other X factor leaders. So the people that are working, the key lieutenants in the business, are not that personality type. And so generally what happens when they leave and expect them, the business runs fine for a while because they're managers. They do the same thing over and over again. But there's been so many instances where people come back and they have to get back in the business a year later because the management team wasn't able to duck and dive and make the changes and lead it, as it were. And we end up selling the business and finding somebody who can. Okay, so talking about valuation methods, there's three basic, and there's more if you're trained in this, but just this helps us visualize what actually happens in practice. The first is the way you're taught in the valuation training. You do a forward plan for 5 years with a terminal value that forecast after-tax cash flows. And this is after-tax cash flow. This is the way you would do it if you were analyzing a company on the stock exchange. So you have, or even commercial real estate, you have an after-tax cash flow, and then you calculate a net present value of that cash flow based on an implied discount rate. Now, my valuation training, about a third of the time was on what rate should that be. We used the build-up method. It ends up being in the low 20s. I can tell you, I did a million exercises, but whatever, you end up with a net present value. Now, not typically, we never use this in practice. It's too complicated. There's very few people that understand it. But I always like to talk about it so people understand the mathematical premise that's underpinning all of this is the cash flow has a net present value. What we use instead is what I call these very crude things called multiples times adjusted EBITDA. If you've had valuation training, it seems very crude, but it turns out everybody uses it, including the private equity guys. And so we have to use it, and we'll go more into that in a minute. Now, that's when you're selling a future cash flow using those two methods. Sometimes that future cash flow isn't worth very much, particularly if the company's at break even. And so the assets in the company are worth more than the net present value, the future cash flow. An example would be a CNC shop with 400,000 pound machines. Maybe they had two of them worth 800,000 pounds, but their profit is only 50,000 pounds. So the cash flow is only worth a couple 100,000, but I can sell the machines for 800. So I might as well just sell the assets off and liquidate. The way I visualize that is that when I'm selling future cash flows, like I'm selling the future milk of a cow, and when I do an asset sale, I'm basically killing the cow and having steak dinner. But you can't have both. And this is where people get confused. They try and add them together. We do a future cash flow analysis that's proxied using multiples, and then people want to add on their CNC machines and say, hey, Ken, I got 500,000 in profit, and my business is worth 2 million, and I have 1 million pounds in machines, so isn't that 2 million plus 1 million? And it's like, no, you got to pick, one or the other. We either sell the future milk of the cow or you either kill the cow and have steak dinner. So when we use multiples, we work on this number called adjusted EBITDA. Now, probably most people on this call know what EBITDA is. That is not the number we use. It's very important to know that. EBITDA will give you the wrong answer. You must use adjusted EBITDA because we have to do the adjustments. Otherwise, you get the wrong answer. It's just math, right? If you miss out on adjustments that adjust a number by 20 or 30% sometimes, the end result is incorrect. And I'll go through what adjusted EBITDA is. And then we use a multiple, and I'm going to go through both of these operators right now. So EBITDA, if anybody on this call doesn't know, is generally a number that mostly is used in the world of M&A to proxy earnings before tax and interest and depreciation and amortization. So we have EBITDA. So EBITDA is not adjusted EBITDA yet, okay? So let's go through what does the adjusted word actually mean. So the adjusted word, we need to actually take out, in the first instance, things the owner has put through the business that are non-operational. So there's a lot of small businesses where they're putting everything through the business. We call them Hawaiian holidays and Ferraris, and they're doing it for tax efficiency. Pension contributions are another one. People with SAS pensions do when a couple family members and you're getting over 100,000 pounds a year going out of a pension. Well, the new guy's not going to have that pension contribution. The new guy's not going to have the holidays to the Far East. The new guy's not going to have people in the business like the owner's wife or the owner's children that aren't really operational in the business, but he's paying them to the business for tax efficiency. All those kind of things that owners do to try and reduce the net income to reduce tax are not going to be present the day after sale. So we need to add them back to show the true profitability of the business. Also, finance charges. If he's borrowed money from Funding Circle or something like that, most deals are done cash-free, debt-free. So the business is debt-free after the fact. You're not going to have the interest charges related to those. And things like COVID adjustments, or the other thing you get is if the owner's not paying himself enough money, he's only doing the 12 grand a year, plus he's giving himself a dividend. Dividends don't count because they're after profit. So if he's only paying himself 12,000 and he needs to be replaced by a 60,000 pound person, that needs to be normalized. Another example is if his pension owns the property that they're on and they're not paying rent on it, but the new guy is going to have to pay rent at 5 grand a month or something, we need to subtract 5 grand from the adjusted EBITDA because he is going to have that cost. So that's a negative add back. So we need to go through all these adjustments to get the proper adjusted EBITDA figure showing the guy buying the business what his real profit situation is going to be. Now, so that's that side, that's that parameter. Now on multiples. Multiples are an interesting thing because everybody's got an opinion. And the reality is that 90% of people with the opinion don't actually sell businesses for real. And in the end, we have all the data. We're sell-side advisors. All we're doing all day long is buying and selling businesses. We have thousands of listings and we have a lot of data. And we can talk to other people that have the same kind of data. And there's some trends. And multiples typically are based on what other businesses have sold for. There's a sort of market value to it. But the important thing to understand about a multiple is they go up and down with risk. Once you get that, you start to understand what they're all about. Now, risk can be how much do I, if I'm going to buy the future milk of the cow, if you think about it, if I give somebody a 4 multiple of adjusted EBITDA, I'm sort of giving them 4 years of profit up front. That's not mathematically totally accurate, but just visualize that for a minute. But then I got to think, well, how likely is it I'm going to get that 4 years of profit, right? Well, if they have recurring contracts, like a SaaS business is the ultimate, pretty likely they've got recurring contracts and they've got a good way of adding them, the ones that have attrition, fantastic. If I have a contractor, like a building contractor, and every single time they have to find a new customer, well, that's really risky. And so the multiple is going to go down. So what we call quality of earnings, how much do I trust that this is actually going to come in? The multiple will go up and down. Other risk factors might be how much do I trust when the owner leaves this business is going to keep running and his key people. He might have one salesman that's doing 80% of the business, but that salesman is his best friend. And so when he leaves, that salesman is likely out of there. Now what? So you have to assess all this. Multiples also go up and down with the EBITDA itself. So you'll find that businesses with EBITDA under £1 million, I'm just telling you this is the data, sell for around 3 to 4 multiple, non-high street. High street is less, like a chicken shop or something is 1.5 or 2 multiple. But if you get something that's at the 200, 300,000, 500,000 EBITDA level, you're probably getting a 3 or 4 multiple of that, depending on the quality of earnings. That's just what the data says. If that exact same business is at 1.5, you're probably getting 5 and 6 multiples, potentially. Again, every business is different. The sectors vary quite a lot, and there's a lot of nuance to this, but this gives you a general idea. But why did it go up just with EBITDA? Because there's less risk. Right? It's like a small airplane is buffeted a lot more in the turbulence than a large airplane. And if you have 200,000 EBITDA, one thing goes wrong and the whole business is, the profit's wiped out. If you have a 1.5 million EBITDA and something goes wrong, you lose 200,000 of that, you're still flying and it's still fine. So EBITDA goes up and down with risk, and different businesses have different risk profiles. You can have supplier risk profile. You're getting all your stuff from one supplier. Customer concentration is another huge one. If you have more than 15% of your revenue with one customer, what happens if they leave? 25% is an absolute red flag. I have clients that are at 50%. We have ways of dealing with that, by the way. Of course we do. Remember the dynamic. The guy selling the business needs to leave to let his life go in another direction, so he needs to sell. If somebody really wants to buy the business because it really makes sense for them, Our job is to engineer ways in deal structuring. And again, I've done over 100 transactions. You get good at this. But you need to engineer ways that's balancing the risk for everybody. And that's part of what we do. But so this is just a general explanation, but that's kind of the idea. Okay, what about excess cash? So basically, every business needs a certain amount of working capital to run. And if you take too much cash out of the business, what happens is the first month end when the new owner needs to make payroll, he's not going to have enough money to pay people. And that's not right because he bought a working business generating the future milk of the cow, generating profit. And so the general rule of thumb is you need to leave enough working capital in the business that it doesn't run out of money in the short term running normally. Short term is say the first 6 months. After that, it's kind of on him. So that's the general math. And generally the way we calculate that, if we can, is we go back and look at the last 12 balance sheets, and then we do an average of the non-cash working items. And that gives us a good idea of what the non-cash working capital level is. You got to factor seasonality into it. This is the longest chapter in all of my books, by the way. There's a lot of nuance to this, and it's normally a great big conversation, but that's the general idea. Anything over and above that is really stored profit. It's cash that the owner has not extracted that really belongs to him. And a business sale is a great time to take it out because if we're selling the business for £1 million and he's got 200,000 pounds of excess cash in the business, then we can write that deal for 1.2 million, and then he's just paying capital gains tax rates on the 200,000 rather than a dividend tax rate. Dividends for that amount might be at 40%. The capital gains tax currently on the first million for each owner is at 14%, unfortunately going up to 18% on the 6th of April, but it's still a lot less than 40%. But anyway, it's a business sale is a good time for him to get his stored profit out. And we do the calculations to make sure the new owner has enough working capital in the business that he doesn't run out in the short term. So that's the way that works. This is a good example of a recast. So if you look at it, the top section here is just straight off of either the management accounts or the filed accounts. The filed accounts would be to the right. The management accounts is in green. Let's just take the left-hand column. So that gives him an operating profit of 448. That's just straight out of the accounting system. And then we add back his director's remuneration because he was paying himself 80,000 pounds. Good on him through PAYE. But then you notice down here in the MD salary normalization, we take out 100,000. He was paying himself 80, but we think we're going to have to pay the new guy 100. And then we also add back in his life insurance, and there was some mortgage interest he was paying, but he's going to extract that property from the business. So we do either a demerger or he sells it out or something like that. That's a whole topic. I have a whole chapter in my book on that, on what to do with property. But basically, the new guy is going to have to pay $22,000 in rent, and that gives us an adjusted EBITDA. If you look at the bottom left here, of $421,000. If we use this period, and we might go back and look at previous periods. In this one, it's like, hey, yeah, this thing is cruising along. It looks like very happily at around the 400. You don't go back and average the last 3 years, by the way. That mathematically doesn't make any sense because remember the game here is to predict the future. And the 3 years ago mathematically has a lot less to do with what next year is going to be than the last 12 months. Typically, we start with the last 12 months, see if it feels about right. And we look at the past years to see if there's a growth trend, or in this case, if it's running about the same, and you make some intelligent decisions. This is the art part, by the way, but that's how you do it. But let's just go with this guy as what we're going to call it 400,000 for the easy math. And we're going to give him a 4 multiple because he's got good recurring revenue and all that. So that gives him an enterprise value of 1.6 million. We're going to give him 900,000 at closing. And that means deferred is 700,000 paid quarterly over 3 years. We're also going to add on his excess cash and leave a 150,000 pound buffer. We're going to write off his director's loan. Again, that works like excess cash. You can add the director's loan to the sale price and then satisfy that 60 grand by a director's loan write-off. This is all done in the accounting. The freehold is moved, and then we're going to give him the car at closing. So that is a typical deal structure using that kind of data. Now, you probably now are gleaning what I said a few minutes ago. The deals are never a number. They're a deal structure. And then you have to map in who am I actually selling to? And also, how much do I trust them? If there's deferred payments, how much do I trust them to run the business after the fact? How solid are they? And then you add in a whole legal overlay on this of how am I going to protect my deferred payments by putting fixed and floating charges against the business. I'm going to put capital controls in so that they can't move assets or cash out until they've paid me. I may have share reversion where if they're late on deferred payments, I start getting shares back. Nobody wants that. It's just a threat and that kind of thing. So there's a multidimensional thing going on here when we do deals. And this is our job to manage that. This is all we do. Our job is to be kind of a dating agent in the beginning where we're finding the right new owner. We do 5,000 reach outs a week at Transworld in the UK. We have massive databases of buyers in different sectors and things like that. You just got to, it's all about timing and finding the right one. Once we find them, we structure the deals. And then basically our day job is project managing a wedding for the next 4 to 5 months to get through due diligence and contracts and funding, post-sale planning and all that. We're doing this over and over again, so we're good at it. I get about 75% of my deals over the line from heads of terms in a world where only 25% are making it statistically across the UK because you get good at it. And when you're only paid at the end, it kind of focuses your mind, to be honest with you. So anyway, okay. So value drivers, basically what drives value in a company very quickly. One is we talked about the X factor leader, that when the new owner is leaving, how involved is he in the business? Well, the less involved he is, the less risk there is. And so that's going to make me feel, less anxious about the owner leaving, and therefore just psychologically, the multiple is going to go up. And so one of the things we get people to do if they have time before they sell is to, as much as possible, they're never going to get totally out of that leadership role. But if they're involved in any kind of day-to-day management or whatever, they need to extract themselves. And we love when our owners talk about how much they play golf and go on month-long holidays and things like that. Other things are customer concentration. We talked about the size of the EBITDA. Also, good books and records are absolutely key. The buyers have to know they can trust what they're looking at when they're doing their calculations. Remember, they're often getting loans against these businesses and giving the data to banks and things like that. And so good books and records is absolutely key. It's the backbone. It's like if you're flying a plane, you need to be able to trust the altimeter and the compass and things like that. That is the end of the presentation. Thank you all for attending. We would love to work with you again. We don't charge upfront fees. We've got 15 offices in the UK. I'm an equity partner. Please feel free to reach out to us if any of your clients are looking at selling, or if any of your clients are looking at buying businesses. It's a great way for them to grow. I've got a book for each one of those. I'm going to send you a free link for that, and we can help them in both cases. Thank you very much.